This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. As impressive as the recent bounce in stocks has been, it is a rally in name only. So says Maria Vateman, our head of equity strategy at State Street Markets, and my guest this week. Large cap tech companies dominate returns, but almost every other corner of the global equity market continues to struggle. And now, with interest rate markets starting to show signs of dislocation, the concentration of equity market returns will surely be more scrutinized, not least given we went through a very similar set of circumstances only 4 years ago after the last major energy price shock. It's a timely reminder this week of how to think about the most meaningful risks in equities and whether fundamentals are still enough to sustain the recovery of recent weeks. Well, Maria, thank you as always for joining. This week, we're going to talk about risk markets, investor behavior, particularly focused on equities. And so, first of all, thank you for coming back.
Oh, my pleasure. Always happy to join the podcast.
Yes, it's always a good chat. And you and Dan Gerard, who was actually on probably about 2 months ago now, 6 weeks, 2 months ago, he had just published a massive piece on global equities and some of the stresses that were maybe becoming apparent during the Iran war. But the two of you have jointly published a huge slide deck on, which is kind of what you do, I think, every month or so to kind of update your views. But there were a couple of things that really stood out that I think are big themes to think about in not just the coming couple of weeks, but the rest of this year, really. All about concentration risk, especially. But where I wanted to start was with your acronym, the RINO rally in equities. Can you explain what the RINO rally is to people?
Yeah, so RINO rally. So RINO stands for rally in name only. I mean,
It's not
inspiration,
Republicans in name
not
only.
Republic. Actually, to be honest, inspiration comes from Brexit in name only, but let's
Ah,
apply it to equity markets. And I mean, I get lots and lots of questions from journalists, from sales, from colleagues, basically saying that, I mean, equity markets are all-time highs, completely, I mean, overly enthusiastic in a world where oil price at 100, over 100, and you have bond yields are pushing higher, and there are inflation risk and growth risk, and equities are just over exuberant. Isn't
yeah,
that kind of too much? I think the answer is, I mean, RINO in a sense is that we have very, very strong rally in tech stocks, but
hmm
nothing else. And I have to say, I was really surprised when I drew a chart of equity returns by sector, by region since the start of the war. And normally you'd expect, okay, when you're all-time high, there is lots of beta in the market and everything goes up together and some markets do a little bit better than the others. But reality has been that outside tech, and like regionally, you get US, you get Taiwan and Korea, majority of the markets are actually down, not just not as much up as those markets, but actually
yeah,
down. They lost money since the start of the war. So, okay, so there is a rally in equities and we're all-time highs, but it's very narrow. So it kind of goes to your kind of concentration idea. But there is no rally in kind of broad equities and kind of
yeah.
equally weighted or kind of average stock is not up. So rally in name only.
Yeah. Yeah. And we're going to talk a little bit about some of the rotations people have tried to make,
Mm.
successful at times for sure, but not necessarily long lasting, away in particular from the US/Asian tech exporter complex, but also on a sector basis, as you mentioned, from tech and communication services. But that is where returns are concentrated and concentration risk comes up. I think I was thinking about this in preparing this morning. One of our colleagues was preparing charts on concentration risk in US equity markets. I think it was probably about 10 years ago. People have thought about this. How do you think investors should think about or care about the concentration of returns just holistically?
I mean, holistically, I think it's really, really important to understand the drivers of those concentrations. So why we are so concentrated. And
Yeah.
I mean, there are some markets that are just geographically concentrated, right? So you have like Taiwan or Dutch stock market, which just, or Danish stock market, which just has one dominant stock. And that's the reality of it. Should that stock rally or collapse, you have this huge concentration. So that's kind of historical artifact. I think for US stock market, which is broad enough, so it's a more kind of interesting concept. And particularly right now, the way we kind of think about concentration and kind of, I'm sure we kind of get to discuss why we are maybe not too worried about concentration is the reason for the concentration in US stock market right now is a concentration of earnings. So that has been the same that Dan Gerard and myself have been talking to clients for the last 3, 4, 5 years about thinking about why the concentration is there. And we can think about like momentum trading, things like that. But it's like underlying earnings that kind of drove the concentration. And I keep thinking back to this idea. So I remember like long time ago, when we kind of were building sector indices and sector strategy, semiconductors used to be one of those sectors which is like really uncomfortable all the time. It was so tiny. And you have to kind of introduce some special constraints for short selling and not because it's just so tiny. And then
Mm,
it grew and grew and grew and became so big. Has it become so big? Exactly for kind of strengths of earnings. So I think it reflects kind of on fundamentals of concentration for sector to become so small, also so large, for the stock to become so large. It's underlying profitability of it. So I think that really gets at the bottom of concentration in larger, more diverse markets. That's a good thing in my mind. So companies that are successful, that are performing really well, become dominant.
yeah.
That's just reflection of it.
Yeah. 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 Exactly. It's a feature, not a bug.
Mm.
And I do want to come back to the limits that might be in place because, of course, market dominance can bring regulatory responses at extreme edge cases, of course. But I wanted to know if there is limits at which forward-looking returns start to suffer, or what is the work that has been done to show whether or not concentration risk is really a problem?
Our colleagues in State Street Associates have published a paper recently called "Fallacy of Concentration,"
Mm,
which with a name giving away the answer.
yeah, kind of
But
tells you
I
what to
mean,
think.
that tells you what to think. But I mean, statistical work is that there is very little like statistical evidence that high concentration leads to weaker returns. So if you look through time, if you look through history, through various markets, there is no strong statistical evidence. And I mean, of course, there are cases, and kind of backward looking, you kind of say, okay, this was concentrated, and then something happened, it collapsed. But yeah, looking systematically, there is very little evidence that concentration is kind of the driving force of big downturn.
Yeah. But thinking about
Mm,
where these concentration
mm,
risks are popping up, we've talked about tech, we've talked about communications, we've talked about US at a country level, Korea, Taiwan.
mm.
So Korea and Taiwan are potentially a US demand story. The US is a, US producer or service provider story. Is this a US story? Like, is this US exceptionalism just writ across the major kind of marginal driver of industry as it stands in the 21st century? Or is it a little bit broader than that?
I mean, it's tech focused, AI focused. If we look at S&P 490, I mean, X tech, I mean, it's performing stronger right now than, say, kind of European counterparts, both in broader kind of rest of the world counterparts based on kind of underlying earnings, underlying prices, but it not like massively, not
Yeah.
significantly better. So it is, I mean, is that US story that tech happened to be prosperous in US? I mean, there is something about regulation, access to capital that helps, regulatory backdrop, taxation, and kind of incentives. That definitely helps, but it is really AI story. Yes, we see broadening of AI trade, but it's not just anti-US or is that kind of movement from US to Asia. It's just finding other ways to play AI trade.
Yeah. Yeah. Well, you picked
Mm,
up on that
mm,
comparison of the non-tech component, US
mm,
versus Europe, let's say, is interesting because there have been rotation
mm,
attempts. And I wanted to kind of complete the thought or get close to completing
mm.
the thought on those attempts. And yeah, I guess every podcast we do, we talk about why doesn't value do better? What, is this the time for mid caps? And you always correctly tell me no, it's not. And but I want to kind of do a post mortem on this because, as I said before, the European defense trade, as one example, last year worked really well until it didn't.
Mm.
But why are these attempts at value chasing so unsuccessful? What underpins? What is the common thread running through the inability for those rotation strategies to really last.
Value is useful measure to kind of get the how strange the springs are. But
Yeah.
you need a catalyst. You need something that say, okay, we have the discount, now it's going to be realized. And that discount for us, like that catalyst, more often than not, probably always, is that earnings expectations. Earnings
Mm.
expectations need to recover. And like taking the example of defense trade. So what has happened last year was, okay, for geopolitical reasons, the European government need to spend a lot more money on defense, and future profitability of European defense companies is a lot better, right? So you have your earnings and you can put higher multiple on it, you re-rate. I mean, sadly, those kind of hopes for better earnings in defense companies are being challenged right now, and we're having all the kind of capacity issues, spending issues. So again, so you have, unfortunately for European companies, what often happens is that the hopes and expectation may be run faster than reality, given the very large discount factor, right? So it's very cheap, so you can as well play, and then I mean, reality kind of catches up, and kind of underlying profitability takes longer to rebuild and requires a lot more pieces of jigsaw fall in place, which again for Europe we're not really seeing right now.
Well, let's think about the final points on concentration risk, and particularly, I mentioned before, I wanted to come back to the limits. Is there a limit at which you think, yes, the market, broad market, and not just the US market, because the US, of course, is a huge component of global market cap. It's just a little bit too dependent on two or three companies. In what in the world has to happen for you to start to actually think, yes, this is maybe a little too much risk that is piled into whether it's two companies or seven companies, or, it's been 10 companies, I think you've mentioned, that have been driving returns from the recent lows. What does that limit look like for you?
I mean, for now, it's in the realm of like hypotheticals because
Yeah.
I don't think we're there yet. Underlying profitability of those companies is really important. And I mean, market is worried somewhat about like cross dependencies between those companies, and that can potentially cause issues. I don't think
Yeah.
we're there yet. I think the companies are still like big tech companies are still exceptionally profitable even without codependencies. Even if something happens in their kind of ecosystems, they're still profitable enough. Their operating cash flows are strong enough to sustain those businesses. So for now, that's kind of not happening yet. So we don't see that. But yeah, building those codependencies, I think that would potentially kind of worry me more and more.
Hmm. And let's take a step back. We are very top down in the way we think. And of course, well, maybe you would recommend someone going 100% long tech stocks, or, levering up and going, 120% long. But let's assume you're not doing that. You're a sort of responsible investor who believes in the power of diversification, whether it's a 60/40 type of framework or an 80/20. I know we've talked about in the past as being preferred. If you had to diversify with something, what is that something in the current environment?
Oh, that's a really nice question. And I think it kind of highlights the way we think about equity market. So what we like within equity. So as I say, I always want to go to underlying earnings, and earnings give
Mm,
me a drive. And when I look at oil shock, and that kind of links to this RINO trade idea. So when I look at oil shock, and I mean, it's one of those kind of nasty ones for economists where you have both growth destruction, demand destruction, and higher prices. And what demand destruction does, it really hurts cyclical sectors. And we're seeing like materials, industrial, consumer discretion are really struggling, right? And on the other hand, it's high prices, so that companies with lower margins tend to struggle because input costs are higher, and it's oftentimes they lose because of demand destruction, they lose pricing power. And which are sectors with the lowest margins? It's healthcare and staples, to some degree, utilities. So your cyclicals are struggling, your defensive are struggling, and I mean, inevitably, all the liquidity there is there in equity markets is going to tech sector and supporting it. So within equities, tech is really kind of Tina. There is no alternative trade.
yeah.
So if you have to hedge, I would probably go to cash. So and do this ultimate barbell, and you have tech and cash, or tech and kind of short end of the curve. Some protection against this kind of stagflationary shocks we're observing now.
Yeah. Actually, that's a good segue to what I wanted to cover next. Everything we've talked about so far basically has been fundamental based. we have a tremendous amount of information on flows and positioning across all sorts of markets and cut in equities by country, by sector, by industry, et cetera. How are investors behaving right now? What does the positioning backdrop look like? And have they been the drivers of this tech view? Have flows sort of really correlated or corresponded to those views?
Yeah, no, that's, I mean, it's fascinating. So this view is, I mean, obviously, I mean, my view on equity market is not independent of what institutional investors are doing. So it's
Of
very
course.
much informed. And we'll look at what investors are doing on a daily basis, of course. But I mean, institutional investors have been fully behind this equity tech concentration trade. It's really fascinating how since the start of the war again in Iran, as end of February, all the flows in equities have been into tech sector. I mean, that's the only sector where holdings have increased since the start of the war, like off benchmark positions have increased. Money came out, I mean, broadly from pretty much everywhere. I mean, industrials and materials and healthcare and staple kind of stand out as sectors where holdings have decreased the most. Regionally, again, US is the only region we saw inflows on the country level, Korea and Taiwan. So your tech trade again. But it's really interesting. So we're seeing outflows from Europe, we're seeing outflows from China, from India. Even Japanese stocks have been seeing kind of position reductions recently. So it's super concentrated. And I mean, we often call it like conviction buying, conviction selling. Positions are very crowded. I mean, no question about it. I mean, we probably should kind of mention that we're recording it just before, day before Nvidia earnings.
Yes,
But
very important caveat.
very,
Yes.
very important caveat, and I hope we're not going to re-record it tomorrow. But
I'm
I mean,
too lazy for that. That's not going to happen. Just
in the
clever editing. That's all.
so in investor positioning in say semiconductors are the highest we ever seen, and they're adding to it. That's quite unusual. I mean, normal investors are a little bit more cautious ahead of earnings, but it is this kind of conviction buying. So positions are really extended, they're very concentrated, and we see them adding. And I think it has this fundamental backdrop where it's really difficult to find a place where you would be confident about underlying earnings and kind of future guidance given what's happening in kind of geopolitics.
Yeah. That answers one of my follow-up questions, especially on semiconductors.
Mm,
Are there other elements, though, whether it's more on the service side of things or, well, especially software now? That's a
mm,
really interesting one, given what happened as part of this attempt to
mm.
rotate earlier this year. Are there pockets of positioning, as a parallel to the concentration risk idea? And, adding to crowded positions is not necessarily a bad thing. It's momentum is everything in a
Mhm.
lot of market regimes. But I'm just curious if there is potential in other areas that positioning maybe isn't as stretched, where you still do have these concentration risks maybe, but they're not as crowded as the semiconductor space.
If semiconductors is the most crowded sector, oh no, it's
Mm,
the highest overweight investor have. Software is the highest underweight position investor
right.
have.
Okay.
So there is this kind of extreme, and I have to say, I mean, again, being optimistic analyst, I'm a little bit more constructive than market consensus on this idea that AI has been kind of a nail in the coffin of software industry. I still see quite a lot of demand for companies that are kind of incumbent companies on business software,
Yeah.
corporate software. That's potentially kind of market is quite negative on kind of overall software sector, and we've seen
Mm,
a really substantial kind of position reduction since mid of last year. I mean, that's stabilized. We see people dipping their toes in the trade, so I think there are some potential again. Have to be selective, but there like their sentiment is improving somewhat. And yeah, positioning is kind of extremely negative. So those extremes, I think, will probably fade.
yeah. Well, you alluded just a moment ago, and I wanted to start talking
Mm,
about the geopolitical backdrop, the macro backdrop, the outlook for rates. And
mm,
I was thinking again earlier today about this is we've kind of had this conversation, but I remember distinctly talking to you about, well, what derails this? And we got the answer in 2022. We got rampant inflation and a policy tightening that was maybe a little bit more than was expected, or was, policymakers were behind the curve and having to catch up and reprice rates very, very quickly. And we have that parallel. I'm just wondering, we have a similar ish set of circumstances now. You have rate markets repricing quite rapidly, duration, right, repricing really kind of as we speak. in a very rapid fashion, perhaps reflective of tighter policy or just neglect of
Mhm.
inflation concerns. And I'm just wondering how you're thinking about this using 2022 as a parallel. Obviously, very different starting points, obviously, very different set of circumstances as it pertained to fiscal policy and when it came to the war in Ukraine, very different implications for global food supply. What are the parallels? What are the differences in your mind that make this maybe slightly better an outlook for these big concentrated risks in equities?
So I'll probably start with actually trumping up Tim. You're in my document we published just recently talking about work we do on narrative maps.
Yep.
So I thought that was really interesting looking at how different markets, equity and FX markets, think about inflation. For FX markets, inflation is the most influential topic. It's highly
Mm,
talked about, and it's really important for US dollar and for rates environment, and it's really in the crux of it. If I look at equity markets, the most influential narrative is corporate earnings and AI. So that matters. Strengths of earnings there, that's what's driving equity market. And when I look at economic variables, interest rates, cycle growth, labor market, all of them are reasonably well talked about, but have very little influence on equity market, on performance of equity market. So is if like if I think about like equity prices, it's like earnings time multiples. Earnings matter and multiples don't. So equity markets are almost kind of I don't want to use word blind, but they seem not to pay too much attention to macro risks at the moment. And
mm,
exactly what we see in investor behavior, right? So investors are very much crowding into tech sector with better earnings. They're not going into defensive. They're not going to sectors that do better when I don't know, interest rate rise occurs, flattens, and mostly defensives. They're not doing that. So we don't see investors kind of paying too much attention. Again, that has been the right strategy so far, and there is momentum in there. Can that last for a long time? Compared to 2022, I mean, the difference potentially was kind of what you were saying, Tim, is central banks were very much behind the curve, and they had to increase rates quite rapidly and
mm,
aggressively. I guess right now, when we have this kind of dual threats of inflation and growth dynamic, I would imagine that policy response much likely to be less pronounced.
mm.
So, I mean, we're talking about market is pricing what like maybe one hike in the next 12 months and for Fed for now. And I mean,
Yeah.
that's changing rapidly, but I think the magnitude of concern on rate side is not as much. But I suspect that the degree of change in interest rates potentially matters. But it's not to kind of to be completely disregarded. So we see, say like financial stocks have been underperforming quite substantially in the last quarter, I would say.
Mm,
That's kind of curve flattening trade. So it is reflected in certain areas, but is it there to derail tech rally? I mean, not yet, at least. I
yeah.
think that's an answer from us.
Well, my next question is going to be what does it look like to derail it? And actually you talked about the narrative map, which I'm really pleased. I said it earlier on a call. I unintentionally wrote one of the more interesting pieces I think I've written the last few months in highlighting the narratives people were
Mm,
focused on, but really more importantly, the fact that our scoring of the media coverage of the Fed has made it now over the last week the most hawkish of the major central banks, which as you pointed out, they're
mm,
not priced to be the most aggressive hikers in response to this
mm.
inflation shock, but they are now receiving some of the most hawkish coverage, which tends to have forward looking implications for short rates. Now, what does a more hawkish Fed do for tech? And then I want to ask part two of that because actually, as we're speaking, US long end yields are hitting the highest levels in about 19, nearly 20 years. How meaningful does a move in either the front end or the long end have to be to actually make this much more a case of it's not just financials, it's a highly correlated risk sell-off of, let's say, 10% or more in the broader indices?
Yeah, I think there are two questions in that. One is, are stocks about to go down? Is
Yeah.
higher interest rate, are they going to kind of topple equity rally? And I think aggressive move in rates potentially can do that. And I think we've been highlighting for quite a while, maybe for the last couple of years, showing that institutional investor stock bond allocation is extremely stretched. So there are definitely positions there. And if indeed we are going into kind of different interest rate regime with significantly higher interest rates, there is definitely things to come out there. But on tech leadership, I still kind of have this view that underlying fundamentals in tech are a lot better than a lot of other sectors. I mean, we talked about financials, we talked about cyclicals, we talked about defensives, and higher rate would kind of hurt those sectors. I would imagine that if rates are quite a bit higher, we'll have stocks going down. Within that, I think tech will probably hold its own.
And the final challenge to the thesis, as I always like to do, and I'm always wrong, is the earnings streams. I think that would clearly be disruptive for returns if there is any sense of earnings expectations being damaged. What does it take for us to get there? Can you describe a scenario where there's an introduction of fragility into some of the expectations for these companies?
Well, as I said, we are recording a day before NVIDIA earnings, so that's your fragility. And I actually have to admit that Mike Metcalf, our head of macro strategy, he keeps calling it macro event when
Yes.
NVIDIA reports. For us, and I mean, that goes back to kind of our previous discussions on value, on rotation, dethroning tech sector. What it will take somebody else, some other sector coming up with an earning stream. And nothing bad has to happen to tech. We know tech is crowded and expensive, and investors have to put up with that just because there is no other alternative.
Yeah.
Should we have better earnings in consumer staples? So finally, healthcare gets through all these regulatory challenges and the cost problems, giving you better earnings. I mean, yes, that would be the trade, and I would sell tech and buy healthcare stocks. You just need to see something else. There are lots and lots of cheap equities to buy, and for now they remain value traps. But there would be a point when those earnings are strong enough for them to become a real value trade, and that would be kind of toppling of tech.
Very unlikely, it would seem, that we'd have something as healthy as tech, but we wait. And Maria, you are about to head off on the road. You're doing some of our research events. Which ones are you going to be at?
So I'm doing London, so looking forward to catching up with London colleagues. And obviously, anybody willing to come to Milan will be very happy to see you there.
You should always be willing to go to Milan. Do seek out Maria's work. Go see her presentation, whether it's in London or Milan. Obviously, you're listening to this podcast, so you're getting a taste of it, but there's so much more. Maria, as always, great to catch up with you. Always great to hear what you've got to say. Thank you so much.
Oh, huge pleasure. Always keen to join you.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. Informational purposes only. It is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.